Hello, and welcome to Greenspoon Marder's Tax Talk. I'm Nick Richards, your host for everything tax all the time. Today on our first show, I've got a good friend and an old colleague, and really maybe the second smartest lawyer that ever left the IRS. Miles Fuller is on the show today. Miles is an executive and director with TaxBit. We're going to talk about what that is, and we're going to talk about crypto. But first, Miles, how are you?
Pretty good. How are you doing, Nick? And I'm glad to hear that you didn't say you were necessarily the first smartest. Maybe there's someone else out there other than me. I assume it's just you.
You bet. I'll let our audience fill that in. They're pretty high end smart folks out there, so I think they're good. But yeah, Miles, all good. So Miles and I were in the IRS together long ago. Miles was there a little longer than me, and Miles, I know that you're now have left the IRS and are part of the team at TaxBit dealing with crypto. Tell us a little bit about kind of how you got into this. What is this crypto stuff? I should have bought that dang stuff years ago, huh? And that's my other question. Did you do that? And now are you kicking yourself in the pants?
Yeah, you and me both.
Yeah.
If I would have thought about it years ago. But no, so I left. So I found my way working at the IRS as a counsel attorney. I stumbled into the crypto space, helping some folks in the field that came across it. And then I had the opportunity there to, as a field attorney, lean in and help the IRS set up its initial program, trying to deal, at least on the civil side of the IRS, with crypto tax compliance. So that would be doing audits. And I was a lawyer there to help assist them. And one of the issues that continuously came up in doing those types of examinations had to do with dealing with crypto-related transaction data, as well as tax questions, and then ultimately doing tax calculations. So to do that, the IRS shopped around and ultimately landed on a vendor to help with that. That vendor was TaxBit, and I became friends with the people there and got to know more. And I took the opportunity to jump to the outside so I could speak a little more freely about issues in the space and data and sort of help resolve some of this stuff. And that's really what TaxBit's all about. It's a software company. Their focus is essentially digital asset, tax and financial accounting compliance. They started focusing on individual users. So that would be like resale customers or people individually doing stuff. They've moved out of that space, and they're really focused on helping exchanges increase their data and provide better information and tax information to their users. And then also we have an arm that handles public sector. So we help governments understand the crypto data better. We help them when they're conducting investigations, do tax calculations when they need those. And that's part of the work that I oversee here at TaxBit. So that's really where we're at. We also have an arm that helps companies that hold crypto on their balance sheets. So if they need to do financial accounting rules, compliance with GAAP or something, we have software for that as well. So that's really what we're doing here at TaxBit.
So the days of we don't know what crypto is, we can't see it. Those days seem to be gone. You guys are playing in the big league with the big players.
Yes, for sure. And so the IRS started on a journey some years ago, even when I was still there, where they started to identify crypto. And you're right, there's a lot of people in the space that think like, the IRS doesn't know what it is. It's all digital, so it's probably not even taxable. And that belief has really changed. The IRS knows what it is. They have actually I think much better. They don't have a perfect understanding, right? They don't have experts who are operating this space day to day, but they have a pretty good understanding of how it works. And they're pretty, on top of trying to chase down bad actors in the space that are not reporting stuff. With that said, they do understand that there's a lot of open-ended tax questions and that there's a lot of uncertainty around the data that's obtained. So when individuals are trying to do their taxes, they may not have the best data, which makes it very difficult to calculate your taxes with. So they're aware of that, but yeah, trying to hide from it. There are situations, I think even before I left, where you still had individuals saying, hey, look, this stuff, I didn't know that it was taxable. And the IRS, I think now is like, yeah, it's been pretty clear that it's taxable. It's taxed as property, and that's where you start. And they're on it. They're increasing their enforcement around this all the time. So it's good for people to be aware.
So back to putting on our IRS hats, that you're talking penalties to me. Are we in an area where penalties are applicable for people that didn't quite understand what's going on now that it's been out so while? We can't get around with that, hey, I didn't know excuse anymore. Is that what I'm hearing from you?
Yeah, I think that might be my take. Like if you put your hands, like, yeah, I think from the IRS side or even from a practitioner side, you're going at it. It's, the IRS's original notice dealing with cryptocurrency at the time, they referred to it as virtual currency. Congress has now given us a statute that uses the terminology digital asset. Virtual currency came from FinCEN guidance, but the initial guidance in the space from the IRS on the tax side came out in 2014. that said, hey, it's property. If you buy it, then you sell it. You may have gain, you may have loss. You got to report it. So if there was a time where people maybe could get away with saying like, oh, I didn't know, like I didn't know, but I think that's out the door. So if you're in that role where you just simply aren't reporting anything, I think the IRS may come at you pretty hard with some penalties, because the I don't know makes it difficult. Now, as a practitioner, if you are trying to do it right, and maybe you do get, you're helping someone with their taxes, or you as a taxpayer, if you're trying to do it right, and you do get audited, and it turns out that the math was incorrect, I think the IRS there is still in a point where they're a little forgiving.
Right.
Of course,
That
that's
makes
always
sense.
depend on who you talk to at the IRS or who you get as an examiner. But if you're trying to do it right, they appreciate that there's a little forgiveness, that the data is not the best, and so there's some and that there's some unanswered tax questions that people keep poking the IRS about and they aren't getting answers to.
But the exchanges have to issue reports now too. If I hold an account, I get a report from my exchange, says what I bought and sold for the year, kind of like a stock account.
Not yet. So that's actually a really
Uh-huh.
good point. So this has like been something that's caused a little bit of concern or something I would say concern with Congress. So in November of 2021, Congress passed a law that would impose that exact type of information reporting on crypto exchanges or brokers, just in the same way as your broker would issue a 1099 document for all your stock trades. That passed in November of 2021. It was supposed to have gone into effect January of this past year, meaning in this coming January 2024, you would actually get a 1099 document. Well, Treasury has yet to finalize any implementing regs to put that law into effect. So none of that's happening yet. The proposed regs were just issued by Treasury back in September. And there was just a public hearing in early November where they did it telephonically, where they talked about like, what is this going to look like? What has to be reported? And a lot of questions like that. So right now, the implementation date that seems to be on the schedule is actually 2025, to have some information where you as a customer of an exchange will get a 1099 document. It seems to be that's going to be called a 1099 DA for digital asset. So you still have a little ways to go, and it's caused a lot of problems. There's some folks on Congress that are looking at the IRS saying like, how are you delaying the implementation of a law that we passed? Like that
Yeah.
raises some questions. But there are people in the space that are like, yeah, this is supposed to help people get better information so they can report their taxes. IRS and Treasury, like, why are you not getting this out? The flip side is there's a lot of exchanges that realize, hey, implementing the tools and the software and the technology to allow this type of reporting takes a little time as well. So that's the trade-off. And that's the space we operate in. We operate in a space trying to enable them to do that. So that's where it's at. So
Miles, do they know who their account holders are?
yes. So at this point, for most, well, I'm going to say yes with a little bit of an asterisk. For most US-based exchanges, they are subject. So outside of tax reporting, they are subject to Title 31 under FinCEN. So they're supposed to be KYC in their accounts. So that KYC, know your customer information, they're supposed to be getting information so they know who the account holders are. And then they can do the reporting. Now, when they do tax, know your customer for tax stuff, that's like W8, W9 information. That hasn't happened for all of them yet because it's not required yet. But a lot of them know. But those are for domestic places that are operating here in the US. Obviously, if you move to an on-chain protocol, which is really operating everywhere and nowhere all at once, just out in the cybersphere, and sometimes with no one behind it, it's just an automated protocol. So it's on-chain activity, like decentralized. We call it decentralized finance is the term you hear a lot for that. Some of those aren't. They aren't collecting that information. And so that's a pain point here, like some of the friction around this. And then obviously, if it's an exchange operating overseas, they're not following US rules. So they may not be collecting information. And US people may be using those exchanges.
It seems like there's a lot there, Miles, and I see stuff in the news almost every day that makes me think, gosh, where are we in this crypto evolution? Are we still in the early days? Interesting. You said 2014, although it sounds like your experience working at the IRS was all after that, trying to figure out how to audit these companies, even after the IRS had come out with guidance on what this asset is. So we're still working our way through it. It would seem to me. But gosh, Miles, I see the Sam Bankman-Fried stuff and the all this different stuff. Is it safe? Tell me about that stuff. What's going on?
Yeah, I think what we're starting to see in the crypto space, so anyone that follows the crypto ecosystem, it underwent a pretty, what I guess I would just describe as kind of a crash through last year, where prices crashed. You had a couple of crypto-related companies, exchanges, lending companies like Celsius, Voyager went into bankruptcy. Then you had the massive blow up of FTX, which is where Sam Bankman-Fried, that was his exchange that had both a US-based component and an offshore component. He ended up being criminally convicted a month ago. And a lot of this came up around a lack of rules or regulations, even when you think about it from regulatory, not so much tax, but maybe SEC or CFTC side. And as all of that happened last year, what you saw early on this year was a big push from both the SEC and the CFTC and DOJ trying to push into the space to clear out some bad actors, prosecute people. Most recently, earlier this year, there was some complaints filed against Binance, as well as its CEO, CZ. And that just seemed to get resolved in the past few weeks. So a little bit of this Wild West element seems to be going away. One of the things I do think caused problem, particularly with the bankruptcy stuff, was a lot of people that just weren't like this level of rules about custodying assets and having reserves and that kind of stuff that we really see in the banking communities didn't exist here, because these assets, this isn't currency, it's not legal tender, this is just property that's being held. And there was not a lot of regulation saying what rules had to be followed. And so that's a little bit of what caused the problem. Now we look at things like FTX, that seems to have just been given the criminal conviction, like a pure fraud, like, you know, units that were told, customers were said, yes, your units are here, we're not touching them, we're not using them, when actually they were touching them and using them for their own purposes. So that's just a straight up fraud. It has nothing to do with crypto. Like, that's almost like a Ponzi scheme type thing. So what we've seen in the past month or two, though, since SBF's conviction, as well as the Binance stuff seeming to settle out because they've reached a settlement with the government here in the United States, we've seen Bitcoin's price start to trend upward. We've seen some other projects start to have some momentum. You and I were talking before the call a little bit about Jito Labs just did an airdrop last week worth a few $100 million to people, and that's a DeFi protocol. So we're starting to see
talk a little
traction.
bit more about that. That sounds very sexy, like an airdrop of all these millions of dollars. Are they dropping it on some island somewhere? How is this working? I think, are there margaritas? This just sounds fun.
Yeah, no, there probably are some margaritas happening somewhere. If you're a recipient of a good promotion to that, you're probably enjoying a margarita or some umbrella drink on a tropical island somewhere. And if you aren't today, hopefully you are in the next couple of weeks, because you got quite a bit of money. But yeah, the concept in the crypto space, when we talk about things like airdrops, I just think of those, like, that's a technical term from a programmer or developer standpoint. I think of us like we're old school tax people. We sort of look past the names. That's the tax rule. Like, you don't care about the names you give things. It's like, what's really going on here? And what's the economics of this? And so really what an airdrop ends up just being, I like to think of, they typically come up as a marketing tool. And it's a way for some project or protocol or something exists that's going to have a token that they want people to use. They give it away for free. So it's just like when a new store, new company does free giveaways to get you in the door.
Yeah.
That's what they're doing here. But they have value. So people place a value. These things trade in markets. And the value is based on whatever it's trading for in a marketplace, whatever the liquidity might be. And then based on that value, that's where this number comes up of a few $100 million. That's what the market was valuing these tokens that were given away as. So that's wow, like a good sign. This is something that hadn't perked up a lot in the past few months. It sort of dried up some, and now we see people taking this activity again.
And, you know, Miles, you talked about a number of different things that start to spark other Web3 thoughts and blockchain thoughts and things of that in my head. But those aren't necessarily part of the crypto verse, right? That's other sort of new technologies that tend to be out there around crypto. But do I need to have a headset to like go out and buy crypto? I mean, is that where we're going with this stuff, or is this, these are just first steps, right? And things are going to get much more robust, I would imagine.
Yeah, you're 100% right. So we hear like terms like lately, you hear Web3, you hear AI, or VR or XR or whatever, all these terms, the technology-based terms, and you hear crypto in there. And there's definitely overlap between these different spaces, but they aren't all the same thing. So really crypto, and when we talk about crypto, really most people are thinking of like crypto assets or cryptocurrencies. And really currency is a misnomer, because it's not currency, it's just an asset that's created. And what you're using that asset for could differ. You could use it in the case of something like Bitcoin. You might be using it in a currency type fashion to make payments, but there's a lot of other ways to use it. But really behind crypto, you think about a deeper technology known as distributed ledger technology. And that's really just taking information and spreading it across various computer nodes, or like servers, if we think a little more old school technology based. And that is just changing up where instead of having everything, you think what I always tell people the analogy, when I go to make a purchase and I walk into Target and I swipe my card and, Mr. Visa or whoever's on the back end of that credit card, that's like Target talks to Mr. Visa, whatever the bank is, the merchant bank, about this stuff, merchant acquiring banks. It talks to them and that bank says yay or nay whether or not I get to make the charge. And then the record of my charge is stored with that bank forever. Really, distributed ledger technology is all about taking the power away from that single bank and spreading it across a network, which makes it harder to corrupt, harder to fraud, and a little bit more egalitarian. And that's really what's happening with distributed ledger technology. The first asset sort of that was tracked with that is stuff like Bitcoin. So we're thinking of these crypto assets. But you don't have to necessarily, it's just storing and tracking information. So that's where you maybe move into more some of the Web3 and how to access things in a more less singular, I'm going to say singular or like single place, consolidated place of storage. And so it's harder to corrupt. It's harder to hack because you can't hack just one computer. Now you'd have to hack an entire network of computers to be able to change things. And so that makes it all more difficult. So there's overlap. But yes, to your question, you don't need to have the metaverse or whatever glasses to be seeing stuff. But things like that, like virtual reality spaces and meta worlds, when you start operating about what are the assets that are moving around in there, some of those assets may be back-end supported by distributed ledger technology, and they may be tradable and have value. And that's really where the IRS goes is, hey, look, even if you have this virtual asset or this digitized asset, if it has value that's in like nominal US dollars and can be easily converted into US dollars, that asset really is property. There's like, we could throw on our old, like you probably had one of those old property law professors, like I had some grumpy guy that's talking about like, Green Acre or something. Like it's that kind of concept. Just because it doesn't exist in a physical form, it's an intangible form, doesn't mean that it can't be property and have value that you would have to report on taxes. And that's really where the IRS is going. I do feel they're becoming less concerned about taxing the technology. They're just trying to say, hey, economically, you have this piece of property, you got something for it, it's worth value. You got to track that and report that. And that's what it's all about. So that might be playing your video game with the goggles on and you bought and sold some land in the metaverse.
Right.
Or you might be trading Bitcoin, whatever it is.
And that decision, is it currency or is it property? Being property made it a lot easier for everybody, I guess, in the end.
Yeah, for sure. And that decision, like people poke around with that, like, why is this not currency? I really just point people back, at least here in the United States, we have a statute. It's a Title 31 statute, part of the US code, that defines what legal tender in the United States is. It says it's the bank, the coinage and the reserve notes of the US Mint or whatever it says in the statute. That's legal tender. So under the tax code, when we think about cash and loans of cash and interest, like interest is a specified thing in the tax code, the rules that apply to interest, that's all when you're talking about legal tender. And if it's not legal tender, then you go back to like, what is it? Well, it's just property. And then when you're in the property bucket, you ask a question like, well, if it's property, does that mean it's a security or does that mean it's a commodity? And as you know, there's some niche rules in the tax world about how securities get taxed or how commodities get taxed, like what accounting methods you might be able to use or some other stuff about straddles. And a good one that comes up here that's a very good example is like the wash sale rule. In the tax world, the wash sale rule says that you cannot sort of sell and into a loss on a security and then repurchase within a certain window of time. Because really the Congress has decided that, hey, that's really like a non-event, like you're just kind of creating a paper loss to put on your tax return. You haven't really given up that asset. But that rule applies specifically to securities. Well, cryptocurrencies or crypto assets, whatever you want to call them, are not securities, at least not always. They could be. So that rule doesn't apply. So it's just this generalized version of property, which still is subject to capital gain rules and that kind of stuff, but it's a little bit different. So that's where you're starting with, I think, the IRS's view from how to approach the taxation, just saying, hey, it's not legal tender, which means it's property. Then we just go from there.
I bet there's some people looking to seize on those opportunities right now because of that as well. Miles, awesome stuff. Obviously you could talk about this for a long time. I'm going to have some more of my chai tea and digest this a little bit before we go next time. But I'm really, really interested in this. I know our viewers are too. Tell us one more time about TaxBit and what's going on there, and then we'll have a slide where we put you in the lights, so to speak.
Yeah, so TaxBit. So if any of you out there are working or you're at a company or something, we really focus on enterprise level compliance software, either tax or financial accounting. So we lean in to help brokers, people that we brokers as far as tax purposes go, get their tax information reporting together so they could file that stuff with the IRS, or until the IRS has fully implemented that, We even have a lot of customers that are just doing it for their customers as a customer experience thing. They want to give their customers good information so the customers can be compliant. That's how those customers keep coming back. So we do that. And then, yeah, separately, we do services to help the government at times with data when they have data issues with this. And then finally, if you have a company that's in this space and your company's looking to hold crypto and you need to follow the accounting rules for that because you have internal auditors or external auditors or you're a public company, we have software that can help you with that. That's what we do. We focus on software that'll track that stuff.
Miles, thank you so much. I'd like to check back in with you after we get into the new year a little bit and see kind of how things go with the IRS, turning up the volume a little bit on these things, and we'll see how that goes. I hope I can call back on you, and thank you so much for joining us.
Yeah, no, so anytime, Nick. Thanks for having me. It's always good to talk to you, and I'm glad you're doing well. As the two top lawyers that left the IRS, we're both doing all right. But I'll be happy to chat anytime with any updates.
Thank you, Miles.
All right, thanks, Nick.